So like I always say, for every exam question you are given, what you need to do is really to read the requirement so that at least you know what the examiner wants you to do in that particular question. So here, this question is from the November 2017 sitting, the financial reporting paper to be specific, and it was question 1. So let's head straight to the requirements and see what the examiner wants. So required, after all these plenty notes, what is the examiner asking us to do? We have 2 requirements. The first requirement is to calculate goodwill arising on the acquisition of Buzz by Spacephone and the goodwill amount that should appear in the Consolidated Statement of Financial Position of Spacephone as at 31st October 2017. If you're able to do this, you score 3 marks. And then our next requirement, which is for 17 marks, is to prepare a consolidated statement of profit or loss for Spacephone Group for the year ended 31st October 2017 in accordance with IFRS. For those who were here on day 3, that was on Monday when we looked at the consolidated statement of financial position. I told you this topic is entirely based on standards. So we have IFRS 3 business combination, IFRS 10 on consolidated financial statements. We've got IFRS 11 on joint arrangements. We've got IFRS 12 on the disclosure of interest in other entities. We've got IAS 27 on separate financial statements, and we've got IAS 28 on investment in associates and joint ventures. So it's a lot of standards covering this particular area of accounting or financial reporting. So let's begin to read the question. We know what the requirement is. So let's begin to pick the relevant pieces of information that will serve as useful. So like I say, always set out your statement because you are in to get marks anyways. So we still have here, I can, I will, I must. Okay. So we are preparing for the, let me get some more space, for the space phone group, right? And like we did the other time, I used the workings. I put workings on a separate page, right? Whilst the statement was on the first page. Here, because we are going to do a lot of the workings on the statement itself. Well, let's even make our life easier, right? Let's do this. That would make everything easy anyways. So let me get a lot more real estate here. Give me a second. Okay, so all right. So this on your exam, this should be first page. This should be the second page, right? You dedicate your first page to the statement of profit or loss and other comprehensive income. Then your second page will be dedicated to your workings, right? That works for all of us. So we have here our workings. Reduce this a little bit. And then here we have for the space phone group, are preparing the consolidated statement of profit or loss and other comprehensive income. You underline it neatly. The examiner keeps mentioning that students do not write the headings to the statement and you are losing marks. So please and please again, just spend a few seconds or minutes or whatever to do this. It's very, very important, right? Make sure you do this in the exam. Okay. So even before we start, let me clean this. Because if you remember, requirement 1 was to compute goodwill, right? So let's do goodwill. So please, in your own on your own workings, obviously, you make sure the working for goodwill, right, comes before the statement here. You get it? It comes before the statement here. All right. So let's continue. We'll do our goodwill up there. I mean, it's the same thing, right? So let's go back to the question and let's begin to read and see what relevant information we can pick from there. So they're saying Space Fund Limited in its quest. So Space Fund Limited in its quest to gain dominance in the telecommunication industry bought an 80% holding in the equity of Buzz, right? And they also bought 40% of the equity shares of Kasapa Limited on what? 1st July 2017. Now, what I want to reiterate here that is when it comes to the consolidated statement of profit or loss, dates are so important. It's because take note the balance sheet or the statement of financial position is an as at statement. What I mean is, it's a statement that is reporting a snapshot of financial position at a particular point in time, right? So, in as much as dates matter in the balance sheet, it won't matter as much as it will in the P&L because the P&L is a periodic statement. It's not asset. It is a statement that reports financial performance over a period of time. So, and typically that period of time is 12 months, right? So, if the question says the subsidiary was acquired for a period less than 12 months, please and please again, you would need to apportion financial results, right? If you do full year attribution, you score 0. Like, it's not even going to be forgivable, right? So please, for the statement of profit or loss, be very careful. Like, be super careful when it comes to the date. Double check, triple check, 4 times check the date of acquisition and the year end, and ask yourself, is it a full year acquisition? If you don't get that and you don't time apportion in cases when it's not full year, you are screwed big time, right? So please, 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 for this type of question, always check the dates, right? So here, they said acquisition was done on which dates? Right here we have what? 1st July 2017. Okay. Then we are told that the purchase price of the investment in Buzz, which you've seen, they bought an 80% holding in, right? So 80 right here. They bought 80 in Buzz, right? So was agreed to be what? 4.4 million. Let me just use this to be safe. 4.4 million, right? Of which 1.6 million was paid in cash. So this is cash consideration, okay? The remaining balance was paid by issuing 800 million equity shares each of 1 Ghana cedi nominal value to the seller at their then fair value of 3 cedis 50 pesos each. Okay. If you multiply, so let's do a quick check. They said purchase consideration right here was what? 4.4, right? So let's just do a quick check here. 4.4 million, right? Okay, and they are saying what? 1.6 was in cash, right? So let's just do 1.6. Okay, so what should be the balance? Calculator. Let's see how much should be in shares. So 4400 minus 1600 gives me 2,800, right? So I'm expecting 2,800. So let's see if we'll get this. All right. So let's all take our calculators. They said the balance was paid by issuing 800 million equity shares of 1 cedi nominal value. So it means 800 million cedis worth, right? At the price of what? 3 cedis 50 pesos each. So multiply 800 times what? 3.5 or 3 cedis 50 pesos. So 800 times 3.5 gives me 2,800. Yes. So it means the total consideration was what? Part in cash, which is 1.6, and part in what? Shares, right? So take note of that in case we need it. But we don't know what the question will say again. So let's keep going. The 20% non-controlling interest in Buzz had a fair value of 900 million cedis. So that's fair value of NCI at acquisition, right? It's 900 million cedis. I'm sure you are all aware we use this to compute goodwill, right? From just ended session before today on what? The statement of financial position, consolidated statement of financial position. Then they're saying Buzz's net assets had a fair value of 4.7 million on 1st July. So that's the fair value of net asset at acquisition, which is also going to feature in the goodwill calculation, which we covered extensively on the session on the statements of financial position, right? Okay. Then Space Fund applies the fair value method to calculate goodwill on acquisition. So goodwill will be what calculated using the fair value method, and obviously will rely heavily on the fair value of NCI at acquisition. Then they say the following statements of comprehensive income relate to Space Fund and its investee companies, BAS and Kasapa, right? So let's read all the notes. Like I say, read all the notes in the question, know what the examiner is going to test you on, and then you can take it from there. So at least what we can do for now is we have information that will enable us to compute the group structure, because we know they own what 80% subsidiary and 40% associate, right? But let's see what the note will say so that we don't make any hasty generalizations or jump into conclusions right now. Okay, so note one, they are saying included in the fair value of BAS's net assets. Take note, BAS is who? Let's check. BAS is the subsidiary, right? So BAS is the sub, Kasapa is an associate, right? Okay, so let's continue. Including the fair value of the subsidiary's net asset. That makes our life easy, right? On the acquisition date was some machinery owned by BAS, but carried at what? 90 million cedis below its fair value. What does this mean? It means they are carrying a certain asset at 90 million cedis that is below fair value. Now, IFRS 3 business combinations requires that in computing goodwill or even in general consolidations, assets and liabilities should be carried at fair value. So, in this case where the machinery is being carried at 90 million below its fair value, we need to what? Fair value adjust it upwards by that 90 million to make sure that the carrying amount approximates or equals what? Fair value. All right, let's continue. The revised fair value was not incorporated into the books of BAS, as BAS has not adopted what a policy of revaluing machinery assets. So BAS does not use the revaluation model when it comes to their assets. So according to IAS 27 on separate financial statements, when BAS is preparing their financials, they do not revalue their machinery. However, IFRS 3 business combination requires that what both parent and subsidiary have what the same what accounting policy. Obviously, this will be what subject to the provisions of what IAS 8 on accounting policies, changes in estimate and errors, right? So here all we need to know is that the revised fair value was not incorporated into the books of BAS because they've not adopted the policy. We are saying no worries. In your separate financial statement, you can use your own policy. But for the purpose of group accounting, for the purpose of consolidation, we need to what? We need to do fair value accounting, right? So the useful economic life of this machinery at acquisition date was what? 6 years. Obviously, when they give you this, they want you to compute depreciation, right? That's all. So what we need to do, remember, is we need to what? Adjust for this fair value. So let's make a note of it. When we start our workings, we'll look at that. So we know this is fair value of the subsidiary's net assets. It's 90 million below fair value. Useful life is 6 years, right? So we know what to look out for. Let's keep going. The next note says what? During the post-acquisition period, BAS sold goods to Space Fund. Once again, who is BAS? BAS is who? BAS is the subsidiary. Space Fund is who? The parent. Remember I told you on the day we're doing the consolidated statement of financial position, I think that was Monday, right? I told you that when it comes to intra-group sales, you need to always ask yourself who sold to who. And remember I told you to write something down? I said if parent sells to subsidiary, NCI is unaffected. If subsidiary sells to parent, NCI is affected. That rule was very important in the consolidated statement of financial position because that meant that if subsidiary sold, the adjustment to provision for unrealized profits was going to hit what? Net assets. However, in this statement, because I'm going to use a columnar approach, it will go to the column of who did the selling. Once again, the provision for unrealized profit will hit the column of the person who sold. So here they are saying what? During the post-acquisition period, BAS sold goods to Space Fund, i.e. subsidiary sold goods to parent. So the provision for unrealized profit adjustment I will do shortly will hit the subsidiaries column because the subsidiary sold, and as such, the effect on NCI should reflect in the subsidiaries what financial reporting. All right, good. So they're saying during the post-acquisition period, BAS sold goods to Spacephone for 50 million. So this is the amount of goods they sold. This is total what sales, right? Total sales 50 million CDs. These goods were sold by BAS at a profit of 30 pesos per every 1 CD on sales price. This is a very fancy way of saying 30% gross profit margin, right? The examiner was tired of using markup margin and wanted to see if students could catch this. How do I know it's 30% margin? Remember, I told you once again on the day we had the balance sheet discussion, consolidated balance sheet or statements of financial position, that what markup was on cost and margin was on what selling price. So here they are saying 30 pesos per every 1 CD on what? On sales price. If it's on sales price, then sales price is what? It's margin, right? How do I know it's 30%? 30 pesos per every 1 CD. You have what? 100 pesos in every 1 CD. So if they are saying it's 30 pesos per 1 CD, then it's 30 pesos per 100 pesos, and that is what 30%, right? So this will be a 30% margin. Take note, 30% margin, right? Good. And they are saying 40%, so we know it's 30% margin. They sold 50 million worth of goods. Good. 40% of the goods remained in inventory as at 31st October, which is the year end, right? So we know that the unrealized portion is 40%. So in computing provision for unrealized profit, which is technically how much profit, or how much in this case margin, is sitting within the books of the related parties or the parent and subsidiary by way of what? Intra-group profit. And take note, the rule in group accounts is that we deem the entities to be what? One single entity. So IFRS 10 on Consolidated Financial Statements says that we would deem the group to be a single entity. So if parent sells to subsidiary or subsidiary sells to parent, we need to disregard those transactions as though they never occurred, because we are saying a man cannot deal with himself and make profit. I.e., if you have 100 CDs in your left pocket and you take that 100 CDs and put it in your right pocket, it doesn't immediately give you 200 CDs, right? If not, all of us will just sit at one place, get 1,000 CDs, take from my left pocket, put in my right pocket, from my right back to my left, and I have 3,000. It doesn't work like that. A man cannot trade with himself and make a profit. That is a rule in consolidation. So we eliminate all intra-group transactions, right? So here we need to eliminate this perceived 30% profit because it shouldn't be there in the first place. At the same time, we will eliminate the 50 million because it means revenue will include a certain 50 million CDs, which will, in the individual financial statement, will be right according to IFRS 15, revenue from contracts to customers. But for group accounting purposes, we do not need to reflect this because we deem the group to be a single reporting entity, right? So on that note, we know that our unrealized profits will be 40%, and we need to eliminate that portion. Okay, next note. There's a since acquiring its investment in BAS, who is a subsidiary, take note, Spacephone is the parent. The parent or Spacephone has managed the administration of the entire group. Spacephone invoiced BAS, or in other words, Spacephone sent a bill to BAS, right, of 4 million CDs for its share of these costs. So Spacephone has managed all the group assets, all the group buildings, all the group everything, right? And they are saying that, yo, BAS, you are a subsidiary, this is your share you need to pay because I've been bearing all the costs so far. You also need to pay something. So BAS's portion is 4 million CDs, and they are saying Spacephone has recorded this transaction within other income, and BAS has recorded within operating expenses, because don't forget that when BAS pays Spacephone, the 4 million, it will be other income to Spacephone, but what it will be a cost to BAS. Once again, the principle I just mentioned, a man cannot trade with himself and make profits. So we will have to eliminate this 4 million CDs. Why? Because you are one group. So why are you paying for something that is already yours? That's the principle. Yes, we know you are parent and subsidiary, but in the consolidated statement of profit or loss and other comprehensive income, you are one big entity. You are one entity. So there's nothing like pay me for your share of the cost. There's no share of cost. It is one entity. So I'll eliminate the 4 million entirely. Nobody should pay anybody for anything. Do you get it? That is the rationale in group accounting, right? So we'll eliminate entirely this amount of what? 4 million CDs. We'll take it from other income and we'll take it from what? Operating expenses to make it zero. Okay, the next note is saying that the goodwill of Baz was reviewed for impairment at 31st October 2017 and was found to have a recoverable amount of what? 400 million cedis. There was no impairment of the investment in Kasapa. So they are saying the investment in the associates is not impaired, right? Take note that IAS 28 investment in associates and joint ventures requires that what you always at least once a year or at least every annual period, you test the associate or the investment in associates for impairment in line with what IAS 36 impairment of assets. So here, what we'll do really is to ensure that we check the goodwill figure we'll compute shortly and see what the carrying value of goodwill is. Remember when we did I think it was on day 2 when we looked at the standards, we said IAS 36 impairment of assets says that anytime you carry an asset at greater or higher than its recoverable amount, then that asset is impaired and must be what? Written down as what? An impairment loss to profit or loss. So here we need to compare the carrying amount of goodwill we'll compute to this recoverable amount of 400 million. If there is what? A higher carrying amount, then we need to what? Write off the excess as goodwill impairment. All right, so we'll look at that when we get there. Then the final note, on 1st October 2017, Space Phone, which is a parent, right? Which is a parent, sold some land to Kasapa for 12 million cedis. So parent sold not to subsidiary, but to who? Associate. Kasapa is associate, remember? So the parent sold land to the associate for 12 million, recording a profit of what? 8 million cedis. Take note that when you sell land, because land is not Space Phone's inventory or their core business activity, they will not record the 12 million sales proceeds in revenue. So it is not sitting in revenue in P&L. No, it will be on the statement of financial position, which we are not preparing today. So if we're doing the balance sheet, then we'll have to what? Eliminate the 12 million either from what? Cash or bank, depending on if they paid cash for it, or in what? A receivable account if it had not yet been paid, right? But here, what will be in the profit or loss statement is this 8 million figure. But take note, because it's an associate and this company owns 40%, right? We need to what? Apportion, because in any case, the portion of the investment you control is 40% and not the full 100%, right? You don't have control, you have significant influence. So now that we have all of this information, let us go and begin to prepare this statement, right? So requirement 1 says calculate the goodwill. Let's do this first before we come to the profit or loss and other comprehensive income. Okay. So standard workings. Remember I told you that your working 1 will always be your group structure, right? So working 1 is our group structure. So here the parent bought some shares in a subsidiary and you also bought some shares in an associate, right? If I remember correctly, we have what? Yes, right here, an 80% subsidiary. So this is 80%. Therefore, our NCI is what? 20%, right? And then the associate is what? This is a 40% associate. Then I told you that dates are very important. So for how long have we had what? This ownership. So let's check the dates. Space Phone bought an 80%, blah, 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 on 1st July 2017. My people, when is this statement being prepared? What year? For the year ended 31st October 2017, right? So they bought the entities on 1st July 2017. Year end is October 17. Please, if you count, how many months we have? We have July, August, September, and what? October. Please, it's 4 months. 4 months. If you miss this 4 months and you make it any other figure, you get 0. Like, I'm not kidding. Because everything will be wrong. It will affect your depreciation, unrealized profit. Like, everything will be wrong. Fine, you get marks for ticks here and there, so you won't score 0. I'm just carrying you, right? To be honest, right? But you won't do as well as you would have done in such an easy question. So please always check the date, right? In the P&L, it's very important. You do not want to lose essential marks just because of something you could have avoided. So please, it's 4 months. So to be safe, let's just write here. This is 4 months ago. This is also 4 months ago. All right, so we know that we have an ownership. We can put a line here because it's not ownership, is what? It's not control, it's significant influence, right? So we know it's 4 months ago. That means for consolidation purposes, we only bring in 4 months worth of results, right? That is what we'll do. All right, now let's begin to compute the goodwill, right? What do we need to compute goodwill? Fair value of consideration. We add fair value of NCI at acquisition, right? Then we less fair value of net asset at acquisition. If I remember correctly, all of this information was included in what? The first paragraph of the question, the very big one up there. But if you remember, there was some fair value adjustment of what? Is it land? No, it was a machinery, right? Yes. Now that machinery, because it will affect net assets of the subsidiary, we need to what? We need to include it before we do the calculation. So this is what I'll do, right? I told you working 2 is called what? Consolidation adjustment. This is following from our day 3 session on the Consolidated Statement of Financial Position. So please, if I keep saying I told you working 2, please take it that you attended that and you are here, so that we don't waste time repeating things we've already said. So we are saying in working 2, that is where you've done, or that's when you carry out all your key workings, right? So please, if you are not here on Wednesday, do well to watch that as well after this session, obviously. So that is it. So this adjustment here, let's go to the note. Note 1, let's take that again. Included in the fair value of Buzz's net asset on acquisition date was some machinery owned by Buzz, but carried at 90 million below its fair value. Below its fair value. Right? So what this means is that we need to what? Fair value adjust this this machinery. If it's carried below fair value, like I said, it means we need to adjust it upwards. So this is just double entry, right? If you want to adjust the machinery upwards or increase the value of a machine, what would you do? You debit, because machineries are assets and assets are debits. So I'll debit the machinery with what? 90, right? Is this question in thousands or millions? Give me a second. Okay, it's in millions. Good. So we debit it with 90. And then we credit net assets of the subsidiary with 90, right? This will increase the value of the machinery by 90, and also correspondingly increase the value of the net assets also by by 90. So we'll remember to do this when we are doing the computation of goodwill, right? Okay, so let's now begin to do our goodwill computation. Since this only adjustment I remember will affect acquisition date. Depreciation is a post-acquisition event, right? So it won't affect acquisition date figures. So let's come here and let's pick out the free information they gave us to compute goodwill. Literally was free information, right? So like I said, let's do goodwill up here. So let's compute goodwill, right? So we know that goodwill is what? Fair value of consideration. Remember the question told us here that let me come here a little bit. Good. They said the purchase price was agreed at 4.4 million right here, right? And they split it into cash and shares. But for goodwill, it will not matter. The total is 4.4, and that's what we'll use, right? So we'll put here 4.4 million. No, actually it's 4,400 million. That's in billion. So look here. So 4,400. Right? Good. Then what do? We add fair value of NCI at acquisition, and that's given to us. Watch here. The 20% NCI had a fair value of what? 900 million, right? So we'll just add what? 900 million. So this is 900 million. Then what do we do next? We less, if you remember the template I gave you, we less fair value of what? Net assets at acquisition. Now here, remember the question gave us a figure. So let's even put here first one. Given in question was how much? It's given to you for free. Watch here. Last sentence. Baz's net asset had a fair value of what? 4,700 million on 1st July, which was what acquisition date. So given in question will be what? 4,700. Then, if you remember, I said what? We did some adjustment here. We said we're going to credit net assets. If you remember, right here, with what? With 90, right? So that 90 is going to increase the net assets. So we need to also top up with this figure. So we just say what? Fair value adjustment of what? Machinery, right? How much did we get for that? 90. So we less that as well. So let's just do the math and see what our goodwill is. So goodwill becomes 4,400 plus 900 minus 4,700 minus 90. And what does that give you? I had 510, so 510. Okay, so my goodwill is 510. Goodwill is what? 510. However, do you remember there was a note that gave us the recoverable amount of goodwill? So let's compare this 510 carrying value of goodwill to that figure to see if it's higher or lower to determine what? Impairment. So if I remember, I was note what? Good. Look at note 4. The goodwill of Baz was reviewed for impairment at 31st October, that is year end, and was found to have a recoverable amount of 400 million. So ladies and gentlemen, a carrying amount of 510 is higher than recoverable amount of 400 million. So the goodwill is impaired, right? So we say, then we less impairment, which will simply be what? Our 510 minus what? The 400 the question gave us as impairment. Really, that's all. The difference should give us what? 110. So we less that. And that will give us what? Our goodwill in what? The statement of financial position. That should give us the 400 that the question said it is supposed to be what is supposed to be held at. So take note, the impairment of goodwill is what? 110 million. And we'll need to what? Actually use this impairment in the consolidated statement of profit or loss. We need to record this. So like I always like to do, I do everything with double entry, right? So let's even do this first one. Give me a second. This working here was for what? Fair value adjustment. So our next working will be on what? Impairment of goodwill. Impairment of goodwill, which remember, goodwill is an asset. So to impair it, what we do, we will credit our goodwill with, I think we got 110, right? Yes, with 110, and then we would debit what? What are we going to debit? It will go to the profit or loss statement, but specifically under operating expenses. So we debit operating expenses with this 110. Let me give you a trick or a very top secret, like high level trick that will help you get the full marks on this question. When it comes to impairment of goodwill, please give it to the subsidiary always, right? Put it in the subsidiaries column. If you are doing the columnar approach, always put impairment of goodwill in the subsidiaries column because technically it's a sub asset, right? Goodwill is a subsidiaries asset, really. So please put impairment of goodwill in the subsidiaries column. So this 110 will be reflected in the subsidiaries column. Let's take note of that, okay? All right, so let's make a mental note that this will be reflected in the subsidiaries column. So ladies and gentlemen, we've done working one. We are done with working one. We've done our goodwill. We know there's a goodwill. If you're able to do this, then we've scored what? 3 marks easily here, right? We have our 3 marks from here. Done and dusted, right? Good. Now that we know this, can we now begin to prepare the statement itself, which is for 17 marks? Okay, so we've already set up our workings here. This is the columnar approach I told you I'll be using. Please pay attention carefully, right? So here, what you do is to open a number of columns. So take note, you have a column for, will this be enough? I'm coming. You have a column for parent, a column for subsidiary, a column for adjustments, and a column for group. So parent, sub, adjustment, group. And then the currency is in what? Millions of Ghana cedi. So Ghana cedi in million, Ghana cedi in million, Ghana cedi in million, and Ghana cedi in million. And to remind ourselves so that we don't make a mistake, remember I told you it's 4 months since you own the subsidiary. So you can write at the top here to remind yourself something small to remember, that please here, this is 4/12. Do this to remind yourself in the exam, right? That this is 4/12. So everything you see in the subsidiaries column or in the subsidiaries statement in the question, you will make yours 4/12 times 4/12. If you don't do this, you are going to be in trouble, right? Okay. Now let's start the statement. It's very easy because we're using the columnar approach. All we'll do is we'll be doing pick and choose, right? So let me show you what I mean. Let's come to the statement. And before I continue, ignore the associates column. See, you do not control the associates. You only exercise significant influence according to IAS 28, right? So you only consolidate the subsidiary by adding across, but the associate, you do not include them at all, except as a one-line item. Take note, subsidiary will be incorporated into these accounts only as a one-line item, and it's in line with what IAS 28 calls the equity method of accounting. IAS 28 says the equity method of accounting would incorporate the subsidiary's profits for the year as a one-liner in the consolidated P&L, right? So please, nobody should be adding across when it comes to subsidiary. If you do that, you're going to score 0, right? So first thing we see here is what? Revenue. So let me reduce this and increase this. So I have my revenue. Simple. What you see is what you put here. What is the parent revenue? Is what? 4428. That is all, right? What is the subsidiary revenue? Take note, please. It is what? 2448. But times what? 4/12. I beg you, don't forget this. Don't put the full 2448 here. Please apportion it. So always check the number of months after acquisition. So here it's going to be 4/12 times what? 2448. My calculator says that gives me what? 816. So I put here 816. For the purpose of the adjustment column I created, we'll use that to just eliminate the intra-group sales and intra-group cost of sales, and that's all. It serves just that purpose. So let me do that now. Let's come to, I think it was, good. Look at note 2. During the post-acquisition period, right here, BAS sold goods to Space for 50 million. So what I'll do is, on the adjustment column, I'll deduct what? 50 million from here. What this is doing is it is taking the 50 million from the revenue. So that shouldn't be part of what? Group revenue, right? Then, next thing we have in the question is what? Cost of sales. So once again, let's just pick what we see. So cost of sales. What is parent's cost of sales? 1674. Okay, let's even add the revenue because we have that figure, right? We have the three elements. So let's add. It's going to be what? 4428 plus 816 minus what? 50. That gives me 5194 of revenue. So I have 5194. Let me write this well. 5194. Perfect. Good. Cost of sales of the subsidiary is what? 864. But please, I told you what? 864 times 4 over 12, right? So let's do that. 4 over 12 times 864. That gives me 288. So I put here 288 brackets. Then adjustment column, I bring 50 here, but this time as a positive figure. And it's just what? The effect of what? Algebra, science, right? If my expenses are in negative in brackets, if I want to reduce it, what do? I use a positive figure. So I'm just bringing the 50 to kind of offset that, right? Okay. Now within cost of sales too should be a figure for things such as what? Provision for unrealized profits, which we have not worked for yet. So let's pause here. I told you the purpose of opening the account and doing the working is as and when you have a figure, you can go and drop it there, get your marks, because it's all about ticks, right? Your job is to pick as many ticks as possible. So let's begin to go back to the workings and work for things such as provision for unrealized profits, depreciation, which will all feature in the P&L, right? Let's come back to our workings. So the next working, what can we work for? Provision for unrealized profit. Remember I told you this question was for margin. So let's go to the notes. They said here, what? Look at notes 2. During the post-acquisition period, bars sold. So we say what? Subsidiary sold to parent. And what? They said it is 50%, no, sorry, 30% per 1 CD. So that's what? On sales price. So that's a markup, a margin, sorry. So it's going to be C plus P equals S, like I did on the Consolidated Statement of Financial Position date. If it is on margin, and I put what? 100 on S. This question said it's 30, so I put 30 here. And then my P will be what? 70. So I want to find my P. So I'll say if my S, which is represented by 100, equals what? They said they sold it for 50 million, so equals 50 million, right? Then what will my P, which is represented by 30, be? So 30, you can put X here and solve cross multiply for X, but I will do if less, more will divide. So 30 over 100 times what? 50. So what does that give me? That's 30% of 50. That gives me what? 15 million. But hold on, they said what? 40% of these goods would remain in inventory at year end. Since you are finding provision for unrealized profit, you need to find what profit is for unrealized, and that is simply the goods that have not been sold. So I say my provision for unrealized profit equals 40% of what? 15 million. So that gives me, so times 40%, that gives me what? 6 million. So my provision for unrealized profit is 6 million, right? How do I record provision for unrealized profit? I like using everything with what? Double entry. It makes me know that I understand what I'm trying to do. Provision for unrealized profit, like I said, is profit that sits within inventory that you want to eliminate. Profit that has been recorded within the books in terms of the statements of what profit or loss that has to go eliminated. So first thing I'll do is to credit my inventory, which will be on the balance sheet obviously with 6 million, to eliminate the profit sitting in there. Then I come and debit my what? My cost of sales with 6 million. Because this debit to cost of sales will increase what? The expense charge, and therefore what? Have the effect of reducing any profits that may be sitting within P&L. So this debit to cost of sales, remember I told you The principle was what? If parent sells, NCI is unaffected. If subsidiary sells, what? NCI is affected. And the rule is that because we are using columns, put the provision for unrealized profit in the column of the person who sold. So here, who sold? Watch here. Subsidiary sold to who? Parent, right? So we put this figure of what? 6 million in the subsidiaries column. So I come to cost of sales here. I create a line for provision for unrealized profit, and I put, what's the figure again? 6 million. I put 6 million under the subsidiaries column, so 6 here, negative, nothing for the parent. And it's only because what the subsidiary did the selling. Please take note, subsidiary sold. Adjustment column is now useless. It has served this purpose, so it can go. Right? What else would typically go to cost of sales? Something like what? Depreciation. If you remember, the fair value adjustment of the land, the extra, the machinery, that extra amount, that extra 90 million. If you remember this one right here, we need to what? Depreciate it, because the question gave us a useful life, right? So let's compute this. Our next thing we'll compute is what? We call it post acquisition depreciation. So here it's simple, right? Depreciation is cost minus residual value over useful life. So we have what? 90 million divided by what? 6 years useful life. That's what the question gave us in note 1, as you can see on the screen. So it becomes 90 divided by 6, and that gives us what? 15 million per annum. But ladies and gentlemen, how many months have we owned this subsidiary? 4 months out of 12. So we say our true post acquisition depreciation will be what? 4 over 12 times what? 15, right? So 15, so times 4 over 12 times 15 will give me what? 5. So 5 million is my what? My depreciation. So how do I record depreciation? Double entry. You know, basic level 1 accounting says depreciation is an expense. So I debit depreciation expense and credit what? Accumulated depreciation. So here, I'll credit what? Accumulated depreciation with this 5 million. Then I debit cost of sales with 5 million. Once again, here, the principle is if it is depreciation, because we are using columns, put the depreciation under the column of the person who owns the asset or the person whose asset has been depreciated. So let's go back to the question and see whose asset it was. Right? Including the fair value of whose assets, bars, and bars the subsidiary. So it means we need to include this figure in the subsidiaries what column. So we have 5 million. So we come here and we say depreciation dash for parent, but 5 for whose subsidiary. So these are the main things that will hit our cost of sales account, so we can prepare and close our cost of sales at this stage. So the math is going to be this: 1674 plus 288 plus 6 plus, no, let me start again. 1674, my calculator messed up, plus 288 plus 6, okay, plus 5 minus 50, and that gave me 1923 or 1923. So I have my cost of sales to be what? 1923, right? So at this stage I can less this peacefully and get my what? My gross profit. And because we are using columns, we need to what? Add across and add down. So what do I mean by this? Let's begin to add across. So let's even do this one first. What is 5194 minus 1923? That gives me what? 3271. So 3271. Let's do the same. Adjustment column is dash, nothing here, right? So you can end there. Let's do for the revenue. So what do we have for the revenue? Let's pull out our calculators. It's going to be what? 4428 minus what? 1674. That will give you 2754. So we have 2754. Let's do same for cost of sales. And it's very important because I told you the subsidiaries column is what we'll use to find our NCI for free, right? So let's add across as well. It's going to be 816. What's minus 288 minus 6 minus 5. That gives me what? 517. Okay, so 517. And as a quick check, we always do this. Let's add across 2754 plus what? 517. Does it give you 3271? Yes, it does, right? So just do a quick check to add across to see if you're on course. So far, we know that what up to the gross profit stage, we are safe. We are fine. Let's go back to the question and continue. Right? Okay. So operating expenses. That's what the question says we should do next. So we come here and we say, okay, our operating expenses. What is the parent figure? 1116, right? So we put here the same way the question has presented it as an expense. So 1116. What is the subsidiaries figure? 828. But please, what? It will become 828 times what? 4 over 12. Please don't forget this, right? So 4 over 12 times what? 828. That'll give you 276. 276. Okay. Do you remember I told you that for goodwill impairment, we always give it to who? The subsidiary. Please, we always give goodwill impairments to who? The subsidiary. Please never forget this. So I come here and I do a subline. I say what? Impairment. So not for the parent dash. What did we get for impairment? If you watch it carefully, I said we'll debit operating expenses what? With 110. So I'll increase my expense with what? 110 under subsidiaries column. Right? So I put an extra 110 here. Please take note of this. All right. Do you remember the note that said that they had charged themselves some amount of money for what? Maintaining the office or something? Yeah, note 3. Right here. They said what? Since acquiring its investment in BAS, Spacephone has managed the administration of the entire group. Spacephone invoiced VAS what? 4 million for the share of these costs. Spacephone recorded this transaction within other income and BAS within what? Operating expense. So who is BAS? So even though this relates to what they said it is included in what? Within BAS as operating expense, it is not something that affects NCI. So you don't put it under the subsidiaries column if you're using a columnar approach. It's an adjustment. So what you can even do is you can even place it under the adjustment side that we are going to what? Adjust for a certain 4 million. We want to add it or want to remove it. So we'll add it as a positive figure. This will have the effect of what? Reducing the operating expenses by what? That 4 million figure. So what we'll do is to get operating expenses for this question is going to be what? Parent of 1116, so calculator, 1116 plus what? 276 plus 110, then minus what? 4. That'll give me operating expenses of what? 1498. So let me clear this. 1498 is my operating expenses. Right? Okay. So we have our operating expenses figure. What else does the question say we should do? Or even to illustrate what we are doing here, we can even have a double entry, like I prefer to have for everything. So next is what? Intra-group. What? Administration. Expenses. So all I'll do is what? I will debit other income with 4 million to reduce it, and I'll credit what? Operating expenses with 4 million to reduce it. So technically that's what I've done over here. This credit operating expenses of 4 million, right, is what I have done right here. Here, right, by reducing it by a 4 million figure. Okay, so let's continue back to the statement. Next after operating expenses, what is finance costs? Oops. It's finance costs. How do I record finance costs? So next line here will be my finance costs. So for my finance cost, what do I need to do? What does the question give me? Oops. I have what? Parent of 180. So I just put this figure here, 180. So parent is 180. Subsidiary is what? 108. But what do I do? 108 times what? You know the drill? 4 over 12. Please take note of this, right? So 4 over 12 times 108. That'll give me 36. So that's what I put here. So I can comfortably add across my finance cost and get the figure for the year. So it becomes what? 36 plus what? 180. That gives me 216. So my finance cost will be what? 216. So I put here 216 and I keep moving. All right, next thing is what? Other income, right? So I break this as well. So other income. What is parent's figure? 32.4. Anything for the subsidiary? No. Right? We don't see anything for the subsidiary. But remember that the question mentioned that what? There is this figure, the shared office expense, right? Which is included in someone's other income. We need to take it out. So if you remember, I said here that we're going to what? Debit other income with what? With 4, right? So we need to what? Come and reduce what? Other income using the adjustment column, right? So that it doesn't affect anyone. So I bring what? A figure of 4 here. This will be a negative because it's what? Going to reduce income instead, right? But hold on, we're not done. When it comes to other income, if you remember, there was something else that they told us was including other income. Watch here, last note, perfect. So on 1st October 2017, Space Phone sold some land to who? Kasapa, that's the associate, right? For 12 million, recording a profit of 8 million. This profit is included within what? Other income in the books of Space Phone, right? So there's a profit of what? 8 million in total. But because it's an associate, only the share of your associate's ownership will come into what? The account. So the profit is 8 million, then we need to include what? The share of that 8 million. So what do we do here? Let's do it this way. Other income. Okay, let's even do it on the face of this account. So let's say share of profit on land, right? So we can do a small working here. It's going to be what? 8 million times, this is a 40% associate, right? So times 40. So let's find 40% of 8. That gives me 3.2. I eliminate it from the parent because the parent has included it in their stuff, right? So let's now find the other income total. It's going to be what? 32.4 minus 4 minus what? 3.2. That gives me 25.2 as my what? Other income figure. So I put here 25.2. This is income, so take note of the positive, right? We are making headway. Let's come here. Then we have investment income of what? 129.6 only for the parent. There's nothing for the subsidiary, so we just drop the whole thing here. These are the kind of marks you can just put in the statement and get a tick. There's no work to be done, right? You definitely get a tick for putting this here. So please, that's why I say make sure you complete the whole question. You can get some of these easy marks without having to work for it. So next is what? Investment income. Parent is what? 129.6. Nothing for sub. So total will be what? 129.6. Right? Okay. You can see here the question stops and jumps to what? Profit before taxation. This is where you step in and bring in your IAS 28 equity accounting method. Because IAS 28 says that what? Your share of your investment in the associate should be recorded what? On the face of what? Profit or loss. So we can say next line will be what? Share of investment in associate. Let's do a working for this. Let's come to the working. And this is easy. Just come to the income statement, right? Let me show you. This is the associate. How much profit did they make for the year? Please, not profit before tax, profit for the year. This is it. Profit for the year, 219.6. That's step one. So let's do this. Our next working is what? Share of associates profit. So first step is what? They made 219.6. Okay, good. How much do we own in this associate? It is 40%. Okay, no problem. Times how long have we owned this associate? Do you remember? It's what? 4 months. So times what? 4 over 12. That is all. Very simple working. Nothing rocket science here. So it's going to be 219.6, right? Times what? 40% times 4 over 12. That gives me 29. Oh, let me change this. 29.28. So I come here, I said I'm working for it. So I put here 29.28. Who is going to enjoy this? It is a parent, because the parent who has made an investment, right? So I put here 29.28. A subsidiary doesn't get this, and it comes to the total of the group 29.28, right? Then at this stage, I can also sum my profit before tax. So my profit before taxation, so this, and then the group. So what I need to do is to add across from gross profit all the way down. It's going to be a long journey, right? But let's do it. So let's start from, I need more space so that we can all see. Okay. So it's going to be what? 3271, right? Let me take my calculator. 3271 minus 1498, 1498 minus 216, plus 25.2, so plus 25.2, then plus 129.6, plus 29.28. That gave me 1741.08. So let me first clean this, guys. Okay. So I have 1741.08, right? So at the same time too, I need to work across downwards as well. So let me just do that quickly. So that becomes 2754 minus 1116 minus 180 plus 32.4 minus 3.2 plus 129.6 plus 29.28. That gives me 1646.08. Okay. 1646.08. 6.08. Let me do that with a sub as well. That looks shorter. So that's going to be 517 minus 276 minus 110 minus 36. I think that is it. Okay, that gives me 95. Okay. Now let me add across. So let me add 95 plus what? 16. So plus 1646.08. It should give me my 1741.08. Yeah, so that shows that we are on course, right? Okay, so we've done after profit before tax. Let's come back to the question here. What do we have next? We have what? Taxation. So nothing new. Let's continue. So let's create a line for taxation. What is the parent's tax? They gave us to be what? 270. So we put that here. What is the subsidiary's tax? It is what? 108. But please what? 108 times 4 over 12, right? Same drill, nothing has changed. Okay, so let me find 108 times 4 over 12. It gave me 36. So my tax here is 36. So let's add across 36 plus 270. Gives me tax of what? 306. Okay. So my tax is 306. So let's find profit for the year. So profit for the year okay, so in simple terms, this is simply going to be what? 1741.08 1741.08 minus what? 306, and that gives me what? 1435.08. So 1435.08. Let's do same for parent and subsidiaries column just for completeness sake. So we have what? 1646.08 1646.08 minus 270. That gives me 1376.08. Okay, next one. 95 minus 36. That gives me 59. Okay, 59. Now let's add across. 59 plus what? 1376.08 should give me what? 1435.08. Good. So we are on course. Now this is where all the magic is about to happen. Do you remember I told you that if you use a columnar approach, your NCI figure will be waiting for you at the end of the question. You don't need to do any extra working. You'll get NCI for free. What do I mean? Let me show you. So when you get to this stage, next thing you need to write is what? According to the presentation format required under IAS 1, presentation of financial statement for groups, you need to what? Split the profit for the year into what? The figures attributable to equity holders of the parent and to what? Non-controlling interest for the year. So we say attributable to who? To two people. First is what? To NCI, and next is to what? Equity holders of the parent. How do I find the NCI figure? Ladies and gentlemen, I just pick the subsidiaries figure here and multiply by the share of NCI. That's all, the percentage. This question, remember, it was what? 80% parent, right? So NCI should be what? 20%. So all I will do is what? It's going to be 20%. So NCI will be what? 20% of 59. This figure right here. That's why I say when you are done, it will be waiting for you. Pick that figure, multiply by what? The NCI percentage, and you're done. You are gone, right? Very easy, very simplistic. Let me undo this. So times 59. Okay. So what does that give you? Let me get my calculator. Give me a second. 20% of 59 gives me what? 11.8. So in this question, my NCI is what? 11.8. What would be the figure for the parent? It's the balancing figure. So the total, when I share, should give me what? 1435.08, which is the exact figure I got here, right? So that's all. The difference between this and the NCI is what goes to the parent. So 1435.08 minus 11.8 will give me parent's figure of what? 1423.28, right? So where do I always? 1423.28. So I've successfully shared profit or loss between what? The parent and a subsidiary. This is the split that will go to parent and NCI. So please use the columnar approach. I encourage you to, because it makes computing NCI almost automatic, actually automatic. If you put the right things under the right column, let me reiterate, impairment of goodwill will always go to the subsidiaries column. You follow the rule that if subsidiary sells, then provision for realized profit will go to their column. If it's a subsidiary's asset, then depreciation will go to their column. All those rules will make sure your NCI is always correct. But next thing we really need to do is to what? Apportion the other comprehensive income. So don't forget that this statement is what? We're preparing the statement of profit or loss and other comprehensive income, right? So if you look at the statement carefully here, we have a place for what? Other comprehensive income. So we need to prepare that as well and apportion it. As you can see over there, there is a figure for what? Gain on revaluation of property for both parent and subsidiary, right? You will agree with me that the subsidiary's figure is not entirely for the parent. So let's just say other comprehensive income. So other okay, let me write this one. Other comprehensive income. What does the question give us? If you check here, they just say what? Gains on revaluation of property, right? So let's just repeat that here. First line is what? Gains on what? Revaluation of property. Same approach. What is the parent's figure? Is what? 226.8. So it also comes here under the same column, right? So 226.8. What goes to subsidiary? 72. But what? Times 4/12. Nothing has changed here, right? So the same approach. Let's apportion. So it becomes 72 times what? 4/12 times 72. That gives me 24, right? So I add these two, 24 plus what? 226.8. That gives me 250.8. Then hold on. If you watch the question carefully, the associate has what? Also a gain on revaluation here of 64.8. If you forget this, you'll be in trouble. You need to add the parent's share of this to the parent's line, right? So let's do a working for that. Similar to what we did for profit. So here, let's just say it's a different working. So we say what? Share of associates other comprehensive income, something like that. What was the figure? They have what right here? 64.8. How much do I own? 40%. For how long have I owned it? 4 months, or 4/12. That's all, right? So it becomes 4/12 times what? 40% times 64.8. That gave me 8.64. 8.64. So that becomes my what? Share of. So I come here and I say share of associates other comprehensive income. I got 8.64. Nothing here. The total will be 8.64. So I sum again, right? So for the parent, that gives me 226.8 plus 8.64. That gives me what? 235. 235.44. Sub is still 24. So let's add across. Plus 24 gives me 259.44. So same thing we do as we did at the top. Let's say attributable to, right? So attributable to what? NCI and what? Equity holders of the parent. Of the parent. Okay. So as usual, I'm going to pick whatever figure I have for the subsidiary and multiply by the NCI percentage. Nothing has changed. So here, NCI will be what? 20% of 24. That's this figure here, right? So 24 times 20% gives me what? 4.8. Then the balancing figure between this and this, the difference will be what goes to the parent. So that gives me minus 259.44. So that gives me 254.64. So when I add these two, I should get 259.44. Right, so we are done. But we need to present something called total comprehensive income. Right, so it's the sum of profit or loss and OCI. Right, sum of profit or loss and OCI. So total comprehensive income attributable to who? To NCI and to equity holders of the parent. So let's just come and sum. Remember we have what? Attributable to NCI for P&L of 11.8 and another one of what? 4.8. So let's just add the two. We're just going to sum across, right? So it's going to be 4.8 plus what? 11.8, and that gives me 16.6, right? So I have 16.6. How much goes to the parent? Simple, right? Proportion. So once again here, 1423. So let me see, 1423.28 plus OCI attributable to parent of what? 254.64. That gives me what? 1677. 1677 point what? 92. So our total comprehensive income for the year will be the sum of these two, right? So 1677.92 plus what? 16.6, right? And that will give me 1694.52. So ladies and gentlemen, if you can do this, you will score 17 marks easily, right? You score the 70 marks that is given here and you'll be on your way to passing this exam. So that's it for this particular question on the profit or loss and other comprehensive income. Now let me use this time to walk you through the things that will probably catch you unawares in an exam, right? So let me tell you, in the profit or loss statement, let me give you some guidance on how to succeed in your exam. First thing you need to do is, please, like I always say, what? Focus on the ticks. Focus on getting ticks. Your job really, let me tell you, how they mark is like this, yeah? Everything you have on this sheet is going to get you a tick. So there'll be a tick for this, another for this, for that. No mark for totals. So you skip this. For the impairment, you get a mark, right? Now the examiner has different ways of allocating. They can say give the student a quarter mark per tick. Some can say a third of a mark. Someone can say what's half or something, whatever. But just focus on getting ticks. That's your job on that day. The more ticks you have, the higher chance of what passing. So what I'll say is please and please again, answer the whole question, attempt everything. You get a tick for group structure, all these workings you've done here. So this double entry should get you ticks, right? Another double entry here should get you what? More ticks. Then you worked for unrealized profits. You're still gathering ticks. You gave them a double entry, another chance to get your ticks. Depreciation, you computed depreciation, you give them post-acquisition, you even gave them double entry, you're getting more ticks, right? Then we came to the intra-group transactions, you gave them what a double entry would look like. Then you came to the share of profit. All of these are different opportunities to get ticked. And then the main statement, please don't forget, the question's requirement is not to do workings. It is to prepare a statement of what? Consolidated statement of profit or loss and other comprehensive income. So all these things here will get you ticks. So revenue, one tick, all of these, right? One tick here, one tick here, one tick here, one tick here. The more ticks you get, right, the better your chances of what passing. So please and please again, your job is really to ensure that you read the question. And I'm sure you can see that when I went through this, it is not as difficult as it will look like when you look at the question at face value. It is not difficult. With a lot of practice, you realize that this thing is really easy to pass. So please focus on the ticks. That's my first advice to you. And one thing I'll hammer home every single day is please what? Time efficiency is key, right? It's a 3-hour paper, so please 1.8 minutes per each mark, right? So this question said 20 marks. So what I would have done is that what I will spend no more than 36 minutes in total. 36 minutes on this question. The A part, which is 3 marks, if I multiply 3 by 1.8, what do I get? Give me a second, my calculator. 3 times 1.8 gives me 5.4 minutes. So it means out of this 36 minutes, 5.4 minutes will be on computing what? Goodwill. If time is up, I'll move on. I don't waste any more time. Then the remaining 17 marks, I multiply 17 by 1.8, gives me 30.6 minutes. Ladies and gentlemen, this is a lot of time. I had 30 minutes roughly to compute this consolidated profit or loss and other comprehensive income. In the exam, if this 30 minutes period is up, move on. Don't spend an extra 2 minutes trying to do anything, because by that 30 minutes, if you were doing the right thing, you would have had enough marks to pass the question. And please take note that every question is your opportunity to what? Pick up some marks that will give you your 50. So please, time efficiency, time efficiency, time efficiency. And then related to this is the advice to what? Answer all questions. I've said time and time again that in this paper, if you don't answer a full question, you will fail. Anybody who doesn't answer a full question in FR and still passes was on their way to winning a prize. That's the truth. They were on the way to winning their prize and then they ended up messing up and they still wanted to pass without a full question. If you want to pass, please answer all questions. The importance of IFRS, let me reiterate that, right? Okay, so this is for the general advice. Specific advice to the statements of profit or loss and other comprehensive income will be things such as what? Check the date of acquisition. Do I have to time apportion? If you miss this, you can be in trouble. The next is what? Things such as goodwill, impairment is generally taken to who? The subs column, right? And then all other things go to what? They go to the column of who it relates to, right? This is it, really. So that's it. If you check the past question trend, I think the examiner is beginning to do this thing where they combine in one question. They ask you to prepare both the income statement and the statement of financial position for a group. No problem. All those type of questions I've seen so far, because you are doing 2 in 1, sometimes it's 10 marks for each, sometimes it's 8 and 12. But the good news for you is that the requirement won't be that heavy because they're asking you to do two things. So it's not going to be a complex balance sheet or a complex income statement. No, it is something you can really manage, just that to have notes that will address both of them. So please practice one of those as well and see. We have done the consolidated statement of financial position. Today we've done the consolidated statement of profit or loss and other comprehensive income. If they bring either of them as a standalone, you are covered. If they bring both of them together, you are also covered, right? So, on this note, let's bring today's session to an end. Please practice a lot more questions. Do a lot of questions on this area. Practice, 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 practice. And then just know that you have it within yourself to pass, that you are ready for this exam, come what may, and that all your efforts will be met with success in the May financial reporting paper. So, let's call it an evening. And the next time I meet you in the crash course series, please take note. It will be on what the preparation of published accounts. It is a question most students run away from. A question that if you ask me, it's very easy because there are so many marks you can pick from there without doing anything. Just picking from the trial balance and dropping it in the question will give you marks. People don't know this, right? The notes are all IFRSs. So like that's why I said you need to know your standards. So let's meet on Friday, right? As we treat published accounts, which will be from trial balance and financial statements. So this Friday at 6 p.m., I'll catch you as we do published accounts. If you want to pass FR, you don't want to miss this, right? So I'll see you on Friday. Our 7 days will be up very soon. Okay, so I do enjoy the rest of your evening. And if you love this, like I always say, don't forget to smash that like button and don't forget to share this video within your entire network. I will catch you in our next video. Bye bye for now.